It is a Friday financial freakout, specifically foreign banks. Take a look at names like Royal Bank of Scotland, Barclays, Banco Santander out of Spain, Deutsche Bank, all are moving down 6%. So here's what we've got. The markets woke up this morning, look, decided it was time to panic about three things that have actually been out there, folks. So I just want to be clear about that. The three things: the Fed meeting next week, the vote 2 weeks from now in the UK on whether Britain should extricate itself from the European Union trade bloc, and global GDP fears, meaning, oh, are we worried that GDP, output, gross domestic product, will start plummeting in a lot of countries? But it's bond yields around the world that are cracking. So this statement, if this isn't drama rolled into massive superlative wrapped in fear, I don't know what is. But let's call it a major warning from the top market player, Bond King Bill Gross of Janus Capital, tweeting out, global yields lowest in 500 years of recorded history. $10 trillion of negative rate bonds. This is a supernova that will explode one day. In fact, look, we wanted to put this together for you. You may not own German bunds or UK gilts, which is the bond in the United Kingdom, but they are dropping precipitously. In fact, Germany's 10-year fell about 42%. It's about to go negative. You got the UK 10-year bond called the gilt hitting a record low going back to the early 90s. And of course, the 10-year Japanese government yield's already negative. Folks, that means that people are paying the government to hold their money just for the promise of getting some of it back. Let's bring in somebody who knows all about this. Jennifer Vail, U.S. Bank Wealth Management, head of fixed income, joining us on the best strategy for the dangerous low yields. We've got traders at the NYSE and the NYMEX as well. I want to get to Jon Corpina first. Why today? Why did the markets wake up and decide that they were suddenly worried about things that here on Countdown to the Closing Bell we have warned people about, John?
We have not seen this risk-off trade in a while, especially on a Friday. You pointed out those 3 points, Brexit, FOMC, and global GDP. Those fears have been in our market. They'll continue to be here. But it seems like today, as we head into this weekend here, and as we get to the end of the month, as we get to the end of the quarter, it's really starting to pick its head up now. What we have on the calendar next week, I think, is really coming to the forefront, and investors now feel that this market has moved up for no real strong reason, and there is a better catalyst that's going to move this to the downside than the upside.
Okay, so the lows of the session, down 172, we're down 157. Again, anything could happen in this hour, but Jennifer Vail, this is your realm of expertise. To see the German Bund, and remember, Germany has been a very solid nation when you're looking in the aggregate at some of the drama that we've seen out of Greece and Portugal and Italy. What should this say to a U.S. investor who holds none of these bonds?
Well, essentially for U.S. investors, if they're not holding the debt, there isn't a direct risk to U.S. investors if they're not holding the debt. The debt is more to, or the risk is more to the U.S. side of the equation in what it's doing to our bond market. You mentioned earlier how low the 10-year has gone already. It also puts some pressure on the Fed, too. The Fed was on this path of policy normalization. So when you have these escalated fears of potential Brexit risk, that puts some tightening of financial conditions into our marketplace and actually makes the path for policy normalization a bit more difficult for the Fed. So I think it's the accelerated, as we move closer to the vote for the Brexit vote, you're seeing higher and higher numbers of those in favor of Brexit. And I think that's a lot of the rationale for the somewhat larger moves that we've seen in gilts, in bunds, and even in the domestic bond market.
Yeah, I look at this and I thought, I woke up today and I thought, now this is strange to see the bond in Germany, the 10-year, start to look like it's about to go negative. Jeff Grossman, to you, oil today has suddenly pulled back. And when we look at what's happening with oil, it's down about 2.6% earlier. But we get the rig count, folks, every single Friday. Last week, it climbed by 9 rigs, meaning they started them back up, thinking things should be okay. And then we added another 3 today. Did we not, Jeff? So yes. As we look at oil in the aftermarket session, I'm seeing it fall now 3%.
Well, again, you know, this is having a bad day. There's no question about it. We're not going to argue that. And again, it's in line with the stock market having trouble here too. But now let's look at it from a bigger picture here. If you look at it from a technical standpoint, we've really just retraced some of the move we had up here. Anything below about 48.5, it starts to get a little dicey here on the downside. Now, with this rig count, I don't look at it as a very big negative yet. What this is showing me is that some of the players want to get back in because they're a little confident the market will work its way a little bit higher here. I think this market still has room on the upside, as I said in the past. I don't say huge numbers to the upside, but again, the mid-50s is something that I think we're going to see possibly even by the end of this month. So don't, get panicky yet. This is a normal technical move that we saw. The rig count, again, I think is a minimal thing. And like I said, I think it instills, shows they have confidence in the market on the upside.
Okay, so Jennifer, if I'm looking at these pathetic bond yields, why would I put my money in treasuries? In fact, why not buy, look, financials happens to have just flipped. It's one of the better performing sectors right now, but some of these actually pay out better yields than the 10-year yield. Shouldn't I be going into stocks with better yields and just wait for the market to perhaps find firmer footing?
Well, that's one of the concerns that many central banks have about negative interest rate policies. Is that it drives consumer behavior into riskier assets that may or may not be appropriate for them. So that's one of the primary concerns. That and bank earnings. If banks are struggling to charge for deposits, that's going to hurt bank earnings. And I think that's why you're seeing, you mentioned earlier, some of the European banks having pretty significant drops in price today. That will be one of the rationales behind that, is that pressure on earnings for financial institutions in the Eurozone.
Jennifer, John, Jeff, thank you on this Friday. And it is a busy Friday, folks. Just a second ago, we were down about 160 points. Watch out. The low of the session for the Dow down 172.